So we have seen how does the model in autarky work. Now we're going to look at how does the model in market equilibrium work. So before we had assumed that the investor cannot buy or sell his assets. But now let's assume that there's a market where investor can sell his long assets. So by this, what I mean is that if he discovers that t is equal to 1, that he's an early customer, that means he needs the money or he needs the resources early, then he can sell his long asset at a certain price P. So he's able to find a buyer for his long asset. So what we mean is that long asset, which was illiquid earlier, now becomes liquid. This actually provides him insurance against any shocks that might come to liquidity. So his liquidity, before we used to assume that he cannot sell it, but now he can sell it and he could get insurance against liquidity shocks. So let's go back to the model. So the model in market equilibrium, it works similarly or very similar to the market in autarky. So we say that at time t is equal to 0, like before, investor has got only 1 unit to invest. Now here's the conditions that we put in earlier is that the amount of capital that he's going to invest in the short-term asset, and the long-term asset, it equals to 1. So he has got 1 unit to invest, and the short-term asset and the long-term asset both should equal obviously the money that he has. So at t is equal to 1, he discovers that he is an early or late consumer. So he needs the money at t is equal to 1, or he might need the money at t is equal to 2. So we assume that he needs the money at t is equal to 1. So X, the long asset, because he needs that t is equal to 1, is priced at P. So of course what he's going to do is he's going to try to sell this asset at t is equal to 1 because he doesn't need the money at t is equal to 2 now, since he's an early consumer. So at C1, we're going to see that his consumption is going to be his short asset, which obviously just stays for one time period, plus P, which is the price of the long asset, times the unit of X, or which is the unit of long asset. So this is what he will have to consume at t is equal to 1 if it's an early consumer. Now if it's a late consumer, then at t is equal to 1, he realizes that actually he doesn't need a short asset because he's going to consume it at time t is equal to 2, not t is equal to 1. So he tries to sell his short asset, which is selling y, and he buys y divided by p units of long asset because the long asset is trading at price p. So total quantity of long asset that he now has is x plus y divided by p. X is the long asset that he originally had, y is the short asset that he sold, and p is the price of the long asset. So consumption at time 2 is equal to be the long asset, which is x, plus the short asset, which is y, and the price of the long asset times r, where r is the return on the long asset. So now we have figured out both consumption at time equal to 1, that is consumption if it's an early consumer, and consumption at time t is equal to 2 if it's a if it's a late consumer. So assuming that we know that this investor is going to consume C1 at t is equal to 1 and C2 at t is equal to 2, can we now work backwards to derive the price that we assumed the long asset traded at? So let's work by assuming that if price is greater than 1. So the price is greater than 1. In this case, what happens is that the consumption at 1 decreases as y increase, and also consumption at 2 decreases as y increases. So we are saying the consumption at any point in time, t is equal to 1 and t is equal to 2, decreases as the units of the short asset increases. So this means that no one is going to take the short asset. So no one is going to hold that. If no one holds that, they are only going to hold X asset, which is the long asset. So we are saying that no one wants to hold the short-term asset and everyone wants to hold the long-term asset, which is not entirely true. And in normal world, that doesn't work because people wants to hold both long asset and short-term asset. Now let's assume that price is less than 1. In this case, what happens is consumption increases at time t is equal to 1 when y increases, which is short-term axis. asset, and also consumption at time t is equal to 2 increases as the short-term asset increase. Now again, in this case, the world turns upside down and no one wants to hold the long asset anymore, and everyone wants to hold just the short-term asset. So what we have said is that P can neither be greater than 1 nor it can be less than 1. So in market equilibrium, P is equal to 1. The price will remain at 1. Okay, so this is a familiar graph. You have seen it before in autarky. How does it work? So what we are saying is the line in the middle, which is a feasible stud under autarky. That's what the consumption will remain bounded by. However, in market equilibrium, we have a certain market allocation, which is consumption C1 remains at 1 and consumption at C2 remains at R. And it will remain that the consumption allocation is always that, irrespective of the investment allocation, irrespective of the fact that they have invested, whatever amount or whatever units in the short-term asset or long-term asset, the consumption allocation will always remain 1 in R. An investor is at least as well off when he has access to asset market as he is in autarky. So we have seen the benefit of trading over here. So we are saying that if there was no trading, the feasible sets, as you can see the sloping line, in this case, if there is trading, he can achieve, or he can be better off than no trading. So trading in a way helps over here to achieve better utility or better consumption. Okay, so we have seen in two models, models in autarky and market equilibrium, whereas one in which you could you cannot trade, in the other one you could. So what we see is there's a problem of liquidity preference in autarky. Investor invests in short asset and is a late consumer. If investor invests in long asset, he's an early consumer. So in both cases, there's a problem. Even if he invests in both the assets, he will still have some regret, because at some point he's going to realize he's either going to be a short consumer or early consumer or late consumer. And if he's an early consumer, if he has invested any, say for example, even 0.1% in the short asset, or sorry, in the long assets, he will still be in a loss. So he will still have some regret, even if it's an early consumer, long consumer, or late consumer. So also what we end up is that the preference for problems in market equilibrium. What we are saying that every person over there is going to hold the same portfolio. And of course, that's not true. People have different preferences and they will hold different portfolios. But we assume in market equilibrium that everyone is going to hold the same portfolio. So this is where the banks actually add value. So we have seen markets in autarky when you cannot trade. We have seen what happens when when you trade. And now we're going to see what happens when banks actually come in and how they add value. So what do banks provide? So these are the advantages. So basically they provide insurance against liquidity shock by pooling investments. So what they do is they tell all these investors, look guys, let's pool all your investments in one place, right? So by doing that, if you need money at some point, we can give you money. Second thing, they say that investors can invest in both short and long assets. They say, okay, we know that you want to invest in a long asset or a short asset, but at the same time, if you're an early consumer, you want the money, and at the same time, if you're long consumer, you still want the money. So we let you invest in both the short and the long assets, and we will save you from any liquidity shocks. Also, if you're an early consumer, we can do this. That if you were an early consumer before, you could, there is no way you could you can get the return that a long asset will produce, because if an early consumer, you will just use the short-term asset and you'll be happy. But banks actually provide you the return of a long-term asset. And as an investor, you can take out money at any point. You can take it out money at when t is equal to 1 and also when t is equal to 2. So how does the bank do all this? So what happens at time t is equal to 0 when investing, or when you say a time period in our model starts? The bank takes deposits from all investors and it pools in the deposit, and then it says that, okay, and as a bank, not as an investor, it invests in the long asset and it invests in the short asset. Now, what it does to the depositor or to the investor, it gives them contracts. It says, okay, you can keep a contract C1 and you can keep a contract C2. by contract, what they mean is that you can withdraw at C1, you can also withdraw at C2, but you cannot withdraw both at T1 and T2 at the same time. You can only withdraw at one point or the other.